Hi, welcome back. In this session, I'd like to take another look at Apple and Amazon now that they've hit $1 trillion. And I want to do it for two reasons. One is I've admired both companies for a long time, and I've valued and reassessed that value over and over again over the last 20 years. I've bought and sold both companies, and I'm interested. I'm interested at $1 trillion whether I should be buying these companies, selling them, or just holding on. So let's look at how Apple and Amazon got to $1 trillion and the different pathways each took to get there. Now, when you look at $1 trillion, that's a lot of money. To get to $1 trillion, you've got to do a lot of things right. Apple and Amazon have had amazing runs over the last 20 years to get to $1 trillion. But if you think that it's been an uninterrupted success up all the time, you're mistaken. Each of these companies has faced challenges over the last 20 years, and the way they've navigated the challenges, reinvented themselves, adapted to new circumstances is a lesson in itself. So here's what I'd like to start with. I'd like to take a look at how Apple and Amazon each got to $1 trillion in market cap, and then we'll dig a little deeper. Let's start with Apple. Apple's march to $1 trillion started with a bad decade, the entire 1990s. What happened during the decade? They lost a charismatic, visionary CEO. A visionary CEO, though, who with his willfulness was actually driving the company into a ditch. He unfortunately was replaced by a management that had no idea what it was doing. By the late 90s, it was questionable whether Apple would make it as a personal computer company. The future did not look good. Now, of course, the rest, as they say, is corporate history. A new CEO came in, a visionary CEO, a CEO with charisma. In fact, the same CEO that got pushed out 6 years ago. This was the second coming of Steve Jobs, and in his second coming, he reinvented Apple. What changed the second time around? That's a topic for another post, but I think he got a much better supporting cast. He got a chief operating officer who made sure the trains ran on time in Tim Cook, and he delivered the vision. And in between 2000 and 2010, you can see Apple's march upwards start to begin. Of course, what created that march were the new products that Apple created during this period, the iPod, the iPhone, the iPad. And over that decade, Apple's market cap kept going up and up and up. And you can see it increase. But it's really between 2009 and 2013 that Apple reaped the benefits of all of its reinvention. You can see that its market cap started to go into hyperdrive, and along the way you can see that it started to become the company that you see today, a smartphone company, a device company rather than a personal computer company. Of course, that run has not stopped. In the last 4 years, since 2014, Apple has continued to climb upwards. Along the way, the company has also changed in financial dimensions. It's acquired some debt. In fact, it's gone from having almost no debt in the last decade to about a 10% debt ratio. Its cash balance as a percentage of value has remained remarkably stable. But because its value has increased so much, the cash balance at Apple today is almost $250 billion. We'll come back and deal with that later. Now, Amazon's march started as a startup. In the late 90s, Amazon, of course, was the poster child for the dot-com sector. And as the dot-com boom unfurled, Amazon's market cap zoomed. But of course, when that dot-com boom bust, Amazon collapsed. And there was a period of time again in Amazon's life where the future looked questionable. Whether Amazon would make it, Amazon did in fact make it through those dark days, survived, and built itself back up during that decade between 2000 and 2010. During this consolidation phase, you started to see Amazon go into other areas of retailing and, in a sense, reinvent itself as a company. But it's really in the last 10 years that you've seen Amazon kind of become a very different company. Amazon, in a sense, is an unusual company. Rather than do what most growth companies do, which is become mature companies, Amazon seems to be reaching back into its past because it is starting to grow again as if it were a growth company. Again, we'll come back and take a closer look at why, but you can see its market value go into hyperdrive from 2011 through 2018 as it climbs from a $100 billion company to almost $1 trillion company. So let's look at the backstory. How did Apple and Amazon get to $1 trillion in market cap? The reason you need a backstory is you don't get to $1 trillion in market cap by accident. There has to be operating success behind the story, but the way in which Amazon and Apple deliver that operating success is very different. In addition, along the way, Apple and Amazon have delivered returns to stockholders, again, in very different ways. And that is going to be the focus for the next part of my story. Let's start with Apple. If you look at Apple's operating history, the way it got out of the dark days was it pushed up revenue growth after the second coming of Steve Jobs. You can trace it back to not only to the new iMacs that he introduced, but to the starting points of the iPod and the iPhone. You can see revenue growth increase and margins double. But it's really again between 2009 and 2013 that you see the hard work really start to pay off. Not only does revenue growth accelerate, but margins almost quadruple. That is the untold story of Apple's success, is how much it improved its profit margins over those 4 years. Then in the last 4 years, there's good news and bad news. The good news is that it's been able to preserve its high margins. The bad news is revenue growth has dropped off. And part of the reason for that is over this period, Apple went from being a personal computer company in 1999 to essentially a smartphone company, deriving more than 60% of its revenues from the iPhone and more than 70% of its operating profits. You're saying, how does it explain things? Well, as the smartphone business has matured, revenue growth has dropped off, and that is now going to become part of my Apple story when I value Apple today. But you can see the company essentially dig itself out of a hole from the late 90s by reinventing itself as a smartphone physical device company. Now let's look at Amazon's operating history. Very different from Apple. Well, the good news with Amazon's history is how quickly it's grown revenues. Revenue growth has always been its calling card. In fact, one reason I used to call Amazon my field of dreams company is they believed, at least the story they were telling markets is, we build it being revenues, they will come, profits will come. And since they were so remarkably consistent about telling that story and delivering on that story, markets cut them a lot of slack. How much slack? Amazon continued to lose money even after it stopped being a startup. It lost money for the first 6 years of its existence. You're saying, okay, it continued to grow. True. It did turn things around and started to generate profit margins. You're saying there, economies of scale kick in. And then again, something strange seems to happen. Margins start to go back down, and the company seems to go back again into its past. It's starting to behave again like a young growth company. In other words, settling for low margins, which it did for much of the last decade, while continuing to push revenues up. So Amazon's history is less about profits and more about delivering revenue growth. There's another aspect in which Apple and Amazon are very different companies. If you look at Apple's cash flows, and here's the best way to measure cash flow. Cash flows to stockholders can be measured as the cash flows left over after taxes, after reinvestment needs, and after debt payments. Apple's had remarkable free cash flows to equity in the last 10 years, but it wasn't always so. Again, from the late 90s through the first decade of this century and leading into today, you can see the buildup of free cash flows to equity, which is what I term the cash that is available to pay to stockholders, especially over the last decade. In fact, if you look at the free cash flow to equity build up over time, and these are cumulative cash flows over periods, you can see that they're very small in the 1990s. They start to build up between 2000 and 2008. They go into hyperdrive between 2009 and 2013, and they become truly unbelievable between 2014 and 2018. How unbelievable? This is the cash left over to be returned to shareholders after every other need has been met. Between 2014 and 2018, Apple generated $242 billion in cash flows. But here's an even more impressive statistic. During that 4-year period, between 2014 and 18, Apple returned $277 billion in cash. $61 billion in the form of dividends, the rest in the form of stock buybacks. No company in history has ever returned this much cash. But here's the final astonishing fact. While they were returning more cash than any other company in history, they actually managed to increase their cash balance by another $100 billion. So how could they pull that off? They're returning more cash than they'd available. Well, they borrowed $100 billion to take advantage of the fact they were cash machines. Apple's cash flow story is essentially what's driven their value. They're a cash machine, the greatest cash machine in history. Now let's look at Amazon. Very different story. Amazon is a cash burning machine in the 1990s. You're saying that's to be expected because it's a young startup, and that's true. And during the next decade, it seemed to turn things around. Cash flows turned positive, which is the natural course of events for growth companies. And then again, you see the last 8 or 9 years. Amazon seems to revisit its young growth days as cash flows turn large and negative again. Amazon is a young growth company that becomes a mature company that seems to have found a second life again as a growth company with a much larger base. And because its cash flows have been so negative, Amazon has returned very little cash. In fact, it's never paid dividends, and it's done 5 stock buybacks in its history, most of them to buy shares back to cover option exercises, options granted to managers in prior years. Amazon is a company that has increased its market value without returning any cash to its stockholders. So, two very successful companies, two very different pathways to delivering $1 trillion in market cap. Now, those two histories are going to provide the basis for my stories and valuations for each of the companies. As I've always said, the value of a company has to rest on your story for the company. And I'm going to try to tell my story for each of these companies based on what I've learned by looking at their histories. The reason I keep emphasizing the word my is not because it's the right story, but it's my story. I expect you to have a very different story. And if you can download the spreadsheets I have that I will attach to this session, you can then change the numbers you don't agree with and make these valuations your own. And I would expect your valuation to be different from mine. Let me start with my Apple story. My story for Apple is that it's a smartphone cash machine and will continue to be so. What does this mean? I think because it's a smartphone company, the smartphone market is maturing and competition is increasing, you're going to see low revenue growth. I'm going to use only 3% growth, essentially the growth rate of a mature company, and give it margins that are lower in the future because the competition is increasing. So low revenue growth, declining margins. You're saying that's depressing, but it reflects my story. You're saying, can't they disrupt another business? Here's the reason. Even though it's possible and perhaps even plausible, I think it's a low probability event. When you're as big as Apple, think of how big the next disruption will need to be for you to even notice. The iWatch is not going to do it. It's got to be a big business, and it's got to be an immensely profitable business. And because I think it's very difficult to find a business like that without expending huge amounts of money up front, I'm going to leave Apple as is. Low growth, declining margins. And with that fairly pessimistic story, I still end up with a value for Apple of about $200 per share. That's about 8 or 9% lower than the price when I did this, but it's within shouting distance of my valuation, but it's mildly overvalued. To value Amazon, I'm going to tell you a different story. I used to think Amazon was a retail company, and the stories I told was how it's going to become the most fearsome retail company in history. I don't think that's true anymore. The more I look at what Amazon is doing around the world, the more I'm convinced that they're a disruptive platform looking for businesses to disrupt. And they're going to go into any business that they think that they can use their platform to disrupt, which effectively opens up the game for them. That's going to explain why I'm going to let their revenues grow at 15% a year. And you're saying that's pretty pessimistic. That might sound pessimistic given their growth rate over the last 10 years. But with the 15% revenue growth rate, I'm giving Amazon $628 billion in revenues 10 years from now. That'll make them the largest company in the world in terms of revenue. So I'm giving them huge revenues because I think they can enter new markets. I'm also going to assume that while they enter these new markets, they will start to see profits from their older businesses. It's already starting to happen in the retail business where they're using the savings and logistics, and added to that the profits of their cloud computing business. They are in fact on the pathway to improving profitability, and I'm going to assume that that's going to continue and that margins pre-tax are going to improve to about 12.5%. High revenue growth, improving margins, make them a very successful company in terms of numbers 10 years out. $628 billion revenues, $78 billion in operating income. With that story, the valuation that I get for Amazon is about $1,255 per share. That's way below the stock price at the time that I did this valuation in September of 2018, $1,950. But that's essentially with the story I've told. One of the things I've learned with Amazon, since I've been so wrong on this company for the last 5 years, is this company finds new ways to surprise me. So if you have a much bigger story than mine, perhaps a story delivering $1 trillion in revenues and 15% margins, you know what? With most companies, I'd say that's impossible. With Amazon, I'm willing to listen. So let's see what the end game here is. I've taken two companies, Apple and Amazon, companies that I love, that I think are great companies, and I value them. The question I'm asking is, they're great companies, but are they great investments? With both companies, I found them overvalued. Now, I've always believed that if you do valuation, you need to be willing to act on those valuations. What does that mean? In the case of Apple and Amazon, if I believe my valuations, I should be selling Apple. Since I already own Apple, I should be selling those shares. In the case of Amazon, perhaps I should be selling short because I find it overvalued by almost 35%. Now, I'm not quite ready to get there yet. And I'm going to leave it in a little suspense. Think of it as an Avengers movie follow-up. Essentially, I'm going to come back and revisit two things that I need to clean up before I make my final investment judgment. The first is I've made some assumptions that I'm uncertain about. In fact, let me take that back. I've made a lot of assumptions I'm uncertain about. I want to face up to that uncertainty. Look at how that uncertainty plays out in my valuation. Second, I'm going to leave this mysterious, but whenever you sell short, you have what I'm going to call the catalyst effect. I know you have no idea what I'm talking about. That is going to be part of my next post, which will be coming in the next couple of days, on what I will need to clean up before I make that final judgment on both companies. Thank you very much for listening, and I hope you enjoyed this session.